Okay, so I told you that I would also talk to you about the aging of accounts receivable method. That's what this is, an aging of receivables analysis. Do you see that? So this is what an accounts receivable aging schedule looks like. The total accounts receivable that they have is $570, okay? They think that $396,000 of it is current. $90,000 of it is 1 to 30 days past due. $36,000 is 31 to 60 days past due. $18,000 is 61 to 90 days past due. And this $30,000 over here, it's over 90 days past due. And here's the thing. Are you going to get paid more? Are you more likely to get paid by someone that owes you recently or someone that owes you for a long time? Somebody that owes you for a long time probably isn't going to pay you as quickly or as maybe as it's as sure as somebody that owes you just pretty recently, right? So that's why when we look at this aging schedule, each age has a different percentage of collectability. Do you see that? So we've got 1% here, 2% here, 5% here, 7% here, and 10% here. And that's because that seems more realistic than just saying, oh, we're going to take 1% of this total $570,000. Instead of doing that, we're going to break this out on the aging schedule and say that our percentage of uncollectability, means the percentage that we're not going to get, goes up as the debt gets older. So you don't make these percentages up. They'd have to be given to you in a question, and you just multiply these out, right? So maybe, let's see what I can do here. So we're going to calculate the estimated balance of allowance for doubtful accounts using aging accounts receivable method, right? That's each receivable is classified by how long it is past its due date, okay? So we're going to look at each percentage and figure it out. So we're going to take 1% of that $396,000, $3,960. We're going to add that to the 2% of the $90,000, $1,800. We're going to add that to the 5% of the $36,000. We're going to add that to 7% of the $18,000. Okay, hold on. And then we're going to add that to, 30% or 10% of the $30,000 for $3,000. So our total, when we add all that together, that's just math, y'all. You can do that. Is $11,820. So that is what we want our allowance for doubtful accounts to be. $11,820. Okay, it's a credit balance, right? Because that's what your allowance should be. So right here, you can see we want our allowance to be $11,820, which is what we just calculated right here. Okay, that's what we want that to be. All right, so come back here. How do we get that? Okay, I can't make it move. My thing's stuck, y'all. Okay. So how do we get that? Let's say that we already have a $3,600 credit in our allowance for doubtful account, okay? And we know we want it to be an $11,820 credit. Well, what do we need to do? We need to adjust it how much? That $8,220 right here. So what's our journal entry? Whoops. What's our journal entry? We're going to debit bad debt expense and credit allowance for doubtful accounts, okay? And then remember I told you that that allowance is a contra receivable, right? Contra asset list with the assets, but it reduces your receivables right here. So you've got your accounts receivable 570 minus your allowance of 11,820 gives you your net accounts receivable, what you think the actual value is, of 558,180. Okay. Now, what if you have a $3,600 credit? Okay. Oh. Well, it says $3,600 credit. What it means is, oops, what if you have a $100 debit? Well, if you have a $100 debit, you want it to be an $11,820 credit. So what do we have to do? We've got to make an adjustment of those $11,920. Do you see that? So how do we do that? We debit bad debt expense and credit allowance. And then the same thing, our net accounts receivable is $558,180. $180. So that's how aging accounts receivable works. It's pretty straightforward. You just have to do the math and then make the adjustments. This bad debt expense and allowance for doubtfuls, that is pretty much the journal entry you're trying to make. You just have to figure out how much. So let me know if you have any questions, and we will be working more on this in your homework in Chapter 9. Thanks.